What were the bank runs of the Great Depression? Have you ever wondered how fear can lead to chaos in the banking system? The bank runs during the Great Depression are a perfect example of this phenomenon. These events occurred when many depositors rushed to withdraw their money from banks, fearing that their banks would fail. This panic was fueled by the belief that their savings were at risk. When large numbers of people all try to take out their money at once, it can overwhelm a bank. Most banks do not keep enough cash on hand to cover all deposits since they lend out a significant portion of the money they receive. This means that when too many people withdraw funds simultaneously, banks can quickly run out of liquid assets. The roots of these bank runs can be traced back to the flawed policies of central banks, particularly the Federal Reserve. After the stock market crash of 1929, many banks began to fail, starting around October 1930. As banks failed, the money supply shrank, leading to a credit crunch. Without enough money circulating, businesses and consumers found it harder to borrow, which led to reduced spending and investment. As depositors lost confidence, they began withdrawing their funds, which put even more pressure on banks. The lack of insurance protections for depositors made people even more anxious. In response, banks tried to hold more reserves and safer assets, but this only made it harder for them to lend money. The result was a deflationary spiral that worsened the economic downturn. From a libertarian viewpoint, the existence of a central bank like the Federal Reserve played a significant role in these bank runs. Libertarians argue that the Federal Reserve's policies contributed to the collapse of the money supply and worsened the economic crisis. They believe that in a free banking system without government control, banks would have had more flexibility to manage withdrawals during times of panic. Historically, before the Federal Reserve was established, banks sometimes suspended withdrawals to avoid insolvency during financial panics. Libertarians argue that this practice could have helped stabilize the banking system during the Great Depression. Additionally, government interventions like the Emergency Banking Act centralized control over banks and money. Libertarians believe that these actions restricted financial freedom and prolonged the economic hardship faced by many. They advocate for a return to sound money principles, suggesting that restoring gold and silver as legal tender and allowing competition in currencies could prevent future crises. In summary, the bank runs of the Great Depression were driven by widespread panic and a lack of confidence in the banking system. Central bank policies played a significant role in exacerbating the situation. From a libertarian perspective, these events highlight the dangers of centralized banking and government control over money, emphasizing the need for financial freedom and sound money principles to avoid similar crises in the future.